Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlotnik, and today it is my pleasure and a privilege to welcome back David McAlvany with McAlvany Precious Metals and Wealth Management. Hi, David.
Mike, great to be back with you. Thanks for having me.
Thank you so much for coming back. And it's one of the hottest asset classes. Precious metals has been kind of the saving grace, the protection against all the volatility and uncertainty of the world. So any starting points about kind of your view of the world today? We are literally recording this on April 3rd. The market is very volatile, and we're seeing lots of nervousness about stocks, crypto, just world trade. Give us a little bit of your view of the world right now. Where are we at? What's going on? Where we go from here?
Yeah, I think you could see gold as a significant signal for what is happening in the world and what is likely to continue to happen in the world. So seeing it through the lens of currency stability is one way that you could view it. We could have a conversation about that. Seeing it through the lens of international relations, through domestic policies, through capital flows and trade settlement, and through the lens of the global financial markets. Each one of those serves as a springboard into understanding gold, why it's behaving the way it is, how we've gotten above 3,100 an ounce, and where we're likely to go next, which I think is considerably higher. Because these are the issues. These are the structural, the fundamental issues which are changing. And again, we had this on full display yesterday in the Rose Garden. These are significant structural changes to the global trade infrastructure, and there's nothing short of a re-engineering of the existing trade infrastructure that's happening today. So does that change international relations? Absolutely. Does it sort of bias the currency markets towards expecting devaluation of the currency? Absolutely, because if we are in fact arguing for gaining an export advantage and putting more of a focus on what we create and sell versus what we consume and import, I mean, that major structural change economically is very considerable, and it ties to the price of gold, because in order to grab that advantage, the export advantage, our currency is at risk. It's always been the case. Exporters are more flexible in managing their currency to lower levels. Devaluation is the temptation for people who want to have export-led growth, and we're saying that that's the way we want to go. So again, through the lens of currency stability, international relations, domestic public policy, capital flows, and trade settlement, and global financial markets. These are all areas that point towards greater demand for the metal and higher prices.
So you're very bullish, obviously, on gold. And gold has been a hedge against inflation, volatility, uncertainty. What about silver and platinum? What is your view of the world? I remember the times when platinum was more expensive than gold. Now the platinum is below $1,000 an ounce, and the gold is $3,100 an ounce. And silver sort of has been lagging as well, but silver hasn't been lagging as badly. It's actually appreciated while the platinum depreciated somehow. So let's just cover this difference. Is there a better value in platinum and silver versus gold, or is still gold is the Cadillac of all precious metals for some reason, and people just want to buy gold?
Yeah, gold is the Cadillac, and there's no doubt, like, that's what central banks buy. If a family office wants to take, 10, 20, $50 million position, it's not going to be in silver. It is in gold. The history of money starts in Lydia, and it's gold coins. Only after sort of the move from Lydia through the Greek states, you finally get to Rome, and Rome is interested in silver coins. So there's bimetallist, there's a history of these two metals being related to money. Gold has always been the anchor. It's been the primary. It's been the Cadillac. Silver is a secondary monetary metal. And in the modern age, of course, neither of them are monetary in nature, and silver and platinum have this industrial component. So, we're in an interesting place where, if you think about the possibility of stagflation, the stagnation part of the economy, slowing or negative GDP growth, which, the GDP now figures from Atlanta went further negative this week. Even if you extract out the imports for gold, which has been a lot from Europe to the US, it's still a dramatic shift from sort of plus 2.3 to negative 2.3. But you need GDP growth for platinum to be doing really well. You need GDP growth for silver to be doing really well. And it's only at a latter stage in a bull market trend where gold gets so expensive that the average investor just says, I can't wrap my mind around spending X amount for gold, but I could buy a lot more for silver. And so you will see silver play catch up to the gold market, but you can expect, because of the Cadillac nature of gold, there can be a long lag period where it performs, and then ultimately silver starts to play catch up. So, today at a 95 to 1 ratio, that's silver to gold, maybe we press towards 100 to 1. Does it make sense to have some silver? Yes, because I do think that while gold, for another analogy, is like the engine driving the train, silver's like the caboose. So we've already had the engine leave the station. You could still look and say the caboose is there. You could still get on board. And I think your relative performance going forward will be vastly different, probably better, because at a 95 to 1 ratio, actually that metal trades to a 60, a 50, a 40 to 1 ratio, implying 100% better returns in silver than gold. So pragmatically, from a gain standpoint, silver is very attractive. From an asset management standpoint, if you're trying to mitigate risk, it has the industrial component. It has sort of an extra flaw in it. Both white metals do, because they're not recession proof. So that's the question. Where do we go from here? Is there more stag than inflation? And if there is, maybe silver still is suffering another few months. I'm attracted to it at 95 to 1. The ratio speaks to me. Price is irrelevant. The ratio speaks to me, because at 95 to 1, if I can move to gold at more of a 40 to 1 ratio out of my silver position, I've doubled my gold ounces. Work the math backwards. If I can double my gold ounces by buying silver today, that's like stepping into the gold market and being able to buy it at $1,500. So Mike, you tell me, 3,000 seems expensive. What if somebody said to you, but I've got a special deal. You can own gold today at 1,500, not the market price, twice that.
Then buy silver, right?
That's right. That's the way the ratio works. That's why these strategies, we've been doing this for 50 years. These strategies are very accretive. Somebody says, I don't know about 3,100. Not a problem. You're going to take a little bit of a gold position, a lot more silver position. As the ratio changes, now you're fortifying your gold position. And even net of taxes, it'd be the equivalent of, say, maybe buying $2,000 gold. So you saved yourself.
Well, it's a relative value. It's all relative value conversation. I've talked quite a bit about this. I've talked about relative value of stocks being so overvalued at the PEs of 30. And then I talked about this a couple of months ago when the PE, the prices were way higher. And now all this, again, I'm not, your guess is good as mine. Nobody has a crystal ball. But stocks look very fully priced or overvalued relative to this PE's ratio, some of the fundamental analysis. But some reason, flight to safety to precious metals continues to be strong. And my comments versus gold versus silver, yeah, you could have a lot more value in a smaller amount of holdings, right? It's easier to buy, like you said, $30 million worth of gold versus $30 million worth of silver. Physically, if you have to store all that stuff, it's a lot more silver you have to store. But on a relative basis, if all you're looking at, just like you said, historic price of gold versus silver ratio, we go from 95 to 100 ratio. Yeah, maybe there's still more upside in the gold relative to silver run, but you're approaching a point of relatively expensive gold and undervalued silver. It's that simple. So if you want to buy something, if you still want to participate in precious metals, then I'd be a buyer of more of a silver than gold today, simply because gold is so it has outpaced silver. So it's just diversification at the end of the day, right? It's a diversification into silver, and you're rebalancing the portfolio in what is relatively less expensive. That's what I'm hearing from you, right?
Yeah, our typical allocation under normal circumstances would be 70% gold, 30% silver, and then maybe a little bit of platinum sprinkled in. So you give up a little bit of the gold position. In this environment, you might flip it 30% gold, 70% silver.
It's
And
that much of a
it's,
relative value.
yeah, I mean, it's, and you should be uncomfortable with that amount of silver. Like the motivation to, I think you need to own gold, period. Is it expensive? Yes. Is it going to continue to perform with central banks allocating to it? Absolutely. This is the trend since 2022 is twice what it was previously. It was 500 tons per year up till that point. We took 300 billion in assets from Russia, and the whole central bank community said, it's worth having a little bit more control of your destiny. And you don't necessarily want the Treasury Department and the State Department of the United States determining your course. So we saw that double to over 1,000 tons. That's been consistent 2022, 3, 4. We're on track for that in 2025, on track for 1,000 tons central bank consumption of gold. So actually what we've seen in the gold price over the last couple of years is primarily because central banks are interested in it. We haven't seen the investor community step in any real way. February of this year was the first time here in the U.S. markets that ETF volumes increased. We had about 72 tons of consumption in the U.S. And that's the first time in 18 months that there's been any real volume in the U.S. So I guess what I'm saying is people would be surprised to say gold's at all-time highs. Business must be booming for you guys, and we must be near the end of a trend. No, the end of the trend comes when the man in the street is buying gold, or buying any asset class for that matter, and we're not seeing that. Like, we've been doing this for 50 years. We know the profile, the psychological signature in the market, and it's not there. This has been family offices, institutions, central banks who've basically said there's a flaw in the system. There's a flaw in the system, and there's greater degrees of uncertainty. We need to address the potential downside with our other asset classes by having this hedge asset in the mix. That's what you've seen over the last 2 years. That's what's taken us from 1850 to 3100. It's not Main Street. So when you look at any particular asset class, it's when Main Street has done their last buying and the last buyer is in, now prices go down. You run out of buyers, prices go down. We haven't even begun to see the retail investor line up. Haven't even begun to see that.
That's a very interesting observation. I've heard, I've asked the same question in the past, and this is essentially the same answer I've heard from other global macro and experts understanding this point, that it's central banks, BRICS, loading up on gold reserves to create an alternative to dollar currency backed by gold to whatever degree. So all this is yesterday's news. Nonetheless, it continues to produce strong ongoing demand, but it's like you're saying, central bank, family offices, institutional demand rather than mom and pop demand, which is basically, it's a great observation. How much of individual portfolio, and you are wealth managers, you help folks with the decision allocations folks should have in precious metals versus their entire portfolio? And of course, this is all relative to individual circumstances, but in general, what's the rule of thumb? How much of precious metals folks should have, could have? How much is too little? How much is too much? What's the right mix? There's no right or wrong. It all changes with times. But what do you think?
Well, different people approach this from either a more or less concerned perspective. So I would say the range of allocation may depend on, if you are by personality, perhaps, a belt and suspenders guy, or somebody who never wears either, So I think everyone should have some gold. I think 5% of net worth is a target for anyone. 10% would be the version of belt and suspenders. So $10 million net worth to have $1 million in ounces, not an issue at all. Now, how that pencils out in terms of, your other allocations from illiquid assets, real estate assets, private owned businesses, like as a percentage of those smaller segments, all of a sudden, 10% looks pretty healthy. And it is. That's why I would say it's an upper range, using it as a net worth figure, not liquid assets or subsets, because everybody is idiosyncratic in that way. Some people are super liquid, some people are super illiquid. So I think the easiest way of penciling it out, net worth, 10% max, 5% minimum.
Yeah, I appreciate that wisdom. I've heard the similar wisdoms. Maybe even you said it on the past podcast. 5 to 10% seems like very reasonable. The only issue that folks have to be obviously aware, if gold doesn't reproduce, there's no yield. It doesn't produce income unless there's some strategies where people can loan the gold that they own or something.
Let's go back to the gold silver ratio. And look at how you position a portfolio, because if you're able to compound ounces, you don't have to have a steady income stream. This is like if I own 1,000 shares of General Electric and I'm collecting my paltry dividend yield. How long is it going to take me to compound my shares using the dividend yield, et cetera, et cetera? Well, I'm going to get a better yield than GE stocks just by doing the gold silver ratio, or even some of the premium trades. Like in silver, you can buy dimes, quarters, 50-cent pieces, the old, what they call junk silver. And that today trades at zero premium. It's interesting because at other parts of the cycle, demand is sufficient that the premiums are 10, 15, 20%, right? So we've had 5 of those trades in 10 years. And so we've been able to compound the premium into free ounces. You're compounding ounces. If I can, over a course of time, start with 1,000 ounces and turn it into 2,000 ounces or 3,000 ounces or 4,000 ounces, depending on how many decades I'm stacking up here, it is a productive asset in the sense that I'm able to generate out of a set amount more. Like there's with strategy comes almost self-generative quality. So I completely agree with you. If you're not approaching the metals market with strategy, and that's one of the differentiators for us in the marketplace. A lot of people will sell you product at a particular price, usually too high a price, and they have no strategy. They're just selling widgets. They could be selling Hoover vacuum cleaners. They don't know anything about anything. They're new in the business because gold's popular or whatever. But strategy is how you take an unproductive asset and compound ounces.
So let me understand. So part of what you offer is storage services and I guess trading services, right?
Sure.
So that's where you're leading the conversation. At least what I'm hearing is the trading is an important part of rebalancing, and I guess you're using your equity in precious metals productively to generate growth in the ounces instead of getting a yield on G stock.
Yeah.
So how do you work with folks on trading? You just basically this stuff is sitting in some secure storage, and they tell you, hey, I have so much gold. Can we retrade that into silver? And you help them rebalance it. And then when the ratio changes from 95 to 50, okay, let's rebalance it again. And then is that the service that you offer?
Right. And that's the gold silver ratio. So we do provide that advice, that advisory service. And that is, again, a key differentiator for us. It's not just product and price, but
do you help them buy and sell through your exchanges? I don't know how it works. I obviously know you can buy publicly traded ETFs to buy gold and silver. But
yeah, so
you buy physical gold and silver. This is stored somewhere. This is storage facility, right?
We use NYMEX, COMEX depositories. You don't want to use like small private depositories. If it's not NYMEX and COMEX, don't touch it with a 10-foot pole. Use a NYMEX, COMEX depository. There's enough flow through those for there to be like a highly liquid market. I've seen some people want to store in Texas and things like this these days. It's not a metals market. Like it's great.
So where's the storage physically? In some secured vaults of
East Coast typically, New York, Delaware, other facilities.
And these facilities enable you to trade. You need to sell. Somebody needs to buy. There's an exchange.
So somebody opens an account. You open an account. It's your account. We have no discretion on the account. Only with your permission do we then can we effect a trade for you? So you open an account and then you send us either a check or wire to fund the purchase. The transaction settles, and those metals, those ounces, are in your name at the depository. They are allocated to you. If you want to go a step above and beyond an allocated position, you can have it segregated. You pay more in terms of the storage cost to have it segregated. But allocated metals, there's a storage fee attached to that on an annual basis, and you wait until we call you and say, this ratio has changed, these premiums have changed, it's time to do something else. And, just to give you an example of the kind of thing that we've done. So 2-3 years ago, American Silver Eagles, 1 ounce Silver Eagles, were trading at huge premiums. And so we were able to move our clients who had lots of Silver Eagles, millions of ounces, out of Silver Eagles into 1,000-ounce bars, and they captured that premium in new ounces within the 1,000-ounce bars. Now, silver's, again, because retail demand is soft, the premiums on those silver ounces, the Silver Eagles, are incredibly low. We've, in some cases, bought them even cheaper than what you would have to pay direct from the U.S. Mint. And so now it's time to move from 1,000-ounce bars back into the Eagles, and we want to play that premium again. There will be demand for silver from the retail street level again, and when that's back, those premiums will be 20, 30, 40%, and we'll be able to do it again. Compound ounces and grow the ounces that someone has on account. You can do it inside of an IRA tax-free, or you can do it with non-qualified money as well, but obviously it's not quite as efficient because of the taxes.
So with IRA custodians, effectively, you just work with custodians to facilitate the trade, and then it gets stored somewhere.
And anybody who will let you have real estate in an IRA will also let you have precious metals. Now you just have to designate a broker who knows what they're doing. And to be honest, the industry is not regulated, and so it attracts.
The Wild West, yeah. A lot of people advertise on TV, spend a ton of money, and then they sell you overpriced product, and yeah.
That's right. So, we don't advertise, we grow by taking care of people, and they take care of us. We've placed billions of dollars into the metals market, worked with tens of thousands of clients, and, we don't have to make a killing, we make a decent living. And by having strategies that help people grow their assets, it makes for long-term client relationships, as opposed to our competition. It's a one and done transaction. Talked to a gentleman just the other day, worked with, probably shouldn't mention the name, but fill in the blanks. If they're advertising on television and with big name radio hosts, you're talking about 30 to 40% commissions, right? It's just massive. Like it's a joke. It's not a financial asset for them. They're fleecing people. You should be paying single digit commissions, period, ever, nothing more. And that's where the industry should be. That's where we operate. But the industry is, again, it's wild, wild west. So, but yes, IRAs are great. Your custodians can handle that. You just need to work with someone. McAlvany Precious Metals, again, 53 years. We love strategy. We love solving problems. And we love helping people understand what's going on in the world. It's one thing to be dazed and confused by events that are going on around us. We love history. We love really silly things like interest rates and international relations and public policy, and we probably read more than we should on the weekends. But it makes for interesting conversations with clients, and I think instructive conversations for them to sort of distill down and have action plans that work under any circumstances. So, we love what we do, Mike.
No, I everything I hear is absolutely gold. I mean, in a matter of speaking, right? You helping them develop a plan. You're helping them approach investing with a purpose, with a strategy, trade from time to time.
Respectful of where gold fits into a larger portfolio. We realize we're just a small niche within a portfolio. There's lots of other asset classes that make a lot of sense. We're just this little niche that, sometimes is an insurance play and is your best defensive strategy. And sometimes, like in football, the way you win a game is with a great defense. And that just happens to be.
It is a defensive, it's a conservative part of the portfolio. The good thing is it's got liquidity, right? You could always go and sell, even if there's no premium in coins. If you own coins, you can still get at least the price of the metal, right?
Yeah.
People don't want the coins; they want the bars. They get the bars. All that makes a lot of sense. How do you mix it up with the? Sorry, just one quick thought. So because you also work with folks on investment into stocks, and I think you mentioned that you have a little bit of that wealth advisory business.
Yeah.
So how does it all mix up? So precious metals pretty clear. I mean, you are long-standing experts. Definitely, folks should consider buying from you versus some guy on TV who's spending a ton of money to be in front of, sell them 30% overpriced product. All that is understood. But how does it mix in today, especially today? We see insane volatility right now. And again, we happen to record this episode on a day of insane volatility in the stock market. And it's kind of crazy. Not only it's volatility, it's a fall. People call it volatility, but the market is a sort of in a nervous breakdown. We've seen this for a while, and we're well into the correction territory. How does it all mix together from your point of view? Folks obviously don't want to panic, but they got to have some strategy. One story that I kind of said many times is applicable to what we do. Commercial real estate is trading on a relative basis at a steep discount because of higher for longer interest rates, market corrected. And then you take highly appreciated stocks and crypto that have done really, really well, and folks should consider rebalancing. And whether it's the right or wrong decision, it's their decision, but it makes sense. You have something's gone up 25% a year for the last 4 years, and then you got something that's fallen down by 25 or 30% off the peak, right? With precious metals, a little different because it has actually done well, right? So it's kind of an interesting mix, and I'd love to hear your thoughts. Even you could provide some commentary. How do you work, folks, on the stock market when you see this type of volatility and the market is going through its thing? What do people do?
Well, so we're unique in the asset management space in a couple of regards. One, we're active managers, so the whole team gets together multiple times a week, goes through 125 different financial market indicators, and scoring our positions, we determine if we're increasing the allocations or increasing our cash. And so going through our routine processes, we come into this week and we've been between 40 and 45% cash for actually about 6 weeks now. So, on a day like today, there's a lot of folks who are hitting the panic button. We don't have to, because the whole notion that financial advisors, you can't time the market. No, you can't time the market, but you can look at valuation metrics and know that you're in the neighborhood of incredibly overvalued. And when you get to sort of a 2 or 3 standard deviation from the mean, and you've only been more expensive, less than 1/4% of all time in all financial market history, that gives you some indication that maybe you can't time the market, but you're awfully close to a top.
Revert to the mean. I present again. My observation was, and I'm not an expert. You are the expert, but my observation is, if you look at P's of S&P 500 on a long-term basis, we've been approaching the stratosphere. When you get over 30, at some point, you revert to the mean. Yeah. So one way or the other, it is more than a standard deviation away. Sometimes you get a couple of standard deviations away where it should be. And then now you got a pretty likely scenario where this looks overpriced, overvalued. And what do you do? Well, you take action, like you said, go into cash.
So the active portfolio management piece is something that you don't get with most financial advisors. It's buy and hold, it's put it all in and hope for the best. And then when things go against you, you just hope that it's going against everyone so that there's no relative disparity and at least everyone's suffering, so you can't be blamed for being wrong. But that's the way it's worked for a long time. The other thing that differentiates us, Mike, is that we are in hard assets primarily. It won't always be this way, but we have a thesis which includes, interest rates being higher for longer. Part of that is a reflection of the quantity of debt that we have in the system and our inability to work it off. But also, we see the inflationary pressures not dissipating anytime soon. Doesn't mean that we're going to be stuck at double digits per year. Doesn't mean we're moving towards hyperinflation. But stubborn inflation makes for stubbornly higher rates. And that represents headwinds for your financial assets. So stocks and bonds, a traditional 60-40 portfolio, is going to experience a harder slog towards profitability in the years ahead. Hard assets are different in that way. Hard assets tend to perform very well in an environment of light inflation and stubborn rates. So, we've seen a differentiation in performance before this week. This week is very volatile, right? But we finished the quarter, and I think the Dow is down, 2%. The S&P for the quarter to date down roughly 4%. Again, probably twice that at the end of the day. NASDAQ was down about 8%, and we were up 10. Being up 10 when others are, so that what I'm getting at is not. The thesis is there's certain assets that perform well under a different kind of environment. We're now in a different kind of environment. So your traditional asset allocations are suffering, and we've had further confirmation of the thesis all last year and this year in terms of performance to say, how are we doing? That doesn't mean that we're neglecting risk, which is why we're over 40% cash. But that gives us flexibility to look at a variety of things today and say, what's getting overdone? Is there a major oil company that's, I'm thinking of one in particular, down 8% today? Is that something that we're going to add 25 basis points to in the portfolio? Or do we need to wait another couple of weeks and see how this sort of flushes out? We're in the catbird seat to buy value. And, we are going to continue to focus on the hard asset space. We define that as global natural resources, precious metals mining companies, specialty real estate, which actually we just sold our last bit of real estate last week. And then the last is I mentioned infrastructure, specialty real estate, infrastructure, global natural resources, precious metals mining companies, those four categories.
Broadly, I appreciate that. The active management is the key word here. The passive strategy has actually been failing because most of the advisors, that's all they do. Because they're just trying to play along with the index, and sometimes the index is highly overvalued, and if you don't take any active steps, it's kind of interesting. Used to be.
I think passive management works in a context of liquidity abundance because everything benefits. There's very little performance differentiation. The only thing that matters is, are you 100% invested, or are you 100% invested and adding leverage to the portfolio? Because that's all a hedge fund does anymore. They just own the S&P, they own the NASDAQ, and then they leverage it 3, 4, 5 times, and they've got superior returns. Not particularly creative in terms of portfolio construction, just a leveraged exposure. That kind of passive approach of just own the index, again, it works when there's liquidity abundance. But if you have anything that shifts the liquidity dynamic, now all of a sudden, active management pays in spades versus everything suffering. Just as everything benefited on the upside, now everything suffers on the downside. And the question is, were you ever fully engaged? Were you ever asking the right questions, or were you just damn lucky? That's the reality. Is most index investors, they just caught an upstroke and were lucky. And now are having to figure out, what do you do? Well, you didn't have a process, you didn't have a team, you didn't have a way of risk mitigating. And so what do you expect? Market turns down, you should be in a panic because you got no plan.
Yeah, that's the crazy part. They have no plan, and there's no. Most professional traders have a stop loss order, and they have a plan no matter what happens. If you have no plan, you're gonna act accordingly. So that's the great wisdom.
Yeah, disciplines, protocols, rules, all of that matters.
David, I appreciate your wisdom. Thank you for sharing on again all the thoughts on portfolio allocation, thinking, planning, gold versus silver. Lots of great nuggets. Wonderful to have you on the podcast. Any final thoughts? Any good book to share? How would folks reach out to McAlvany Precious Metals for wealth management? What's the best way to reach out?
Yeah, our main website is McAlvany.com, and from there you can scurry over to either the precious metal side or the asset management side. So McAlvany is ALVANY.com. Or you can call us at 800-525-9556. We've had the same 800 number for 50 years. It's pretty funny.
Well, it's a family business, right? I guess your father started it and you continue to run.
That's right. Second generation. A couple resources. We do a podcast every week. That's helpful. If you're interested in hard assets, we write on a Saturday something called Hard Asset Insights. You should get on that list. It's free, and it's typically 3 to 5 pages. That's helpful. It's a summary of kind of our portfolio interests in general and the factors that are impacting those portfolio segments. Other resources, if you're interested in interest rates and their impact on markets in general, I think a really healthy book to read, The Price of Time, and written by Edward Chancellor.
The Price of Time. Yeah, it's easy to remember.
Yeah, it's really good. I mean, there's so many different things that could be helpful. I think you've got to recognize the importance of your education as an investor to be able to make empowered and informed decisions. And, the delegating process, ultimately partnering with other people, may be, in the final analysis, a part of how you navigate the markets. But doing so as an informed partner is really important. So, focusing in, as John Templeton said, one of the best investments that you can make is in yourself. That means you've got to take ownership of the gaps in your education, financial education. If that's, studying cap rates, if that's, studying interest rate trends, if it's, there's just so many things to learn. And yes, you can ultimately work with some smart people that help with niche areas, but you've got to be an informed consumer. And our podcast has been going for 18 years every week. We try to bring, a lot of education, put 10 pounds of mud into a 5-pound sack every week. And in 30, 40 minutes, have people be, the most informed in their sort of sphere of influence in universe, sitting around the water cooler at the office. We'd like our listeners to be asking the very best questions, or, Thanksgiving dinner, family dinner on a Sunday, why are you asking that? That makes so much sense. That's what we want our investors to be, sort of leading a conversation and bringing insight to every relationship they have and every decision they make.
Yeah, understood and agree. Education is the best investment you can make, period. There's nothing else. So even it beats the investment in gold and precious metals.
Yeah. McAlvany.com. My pen leaked on my hand. Great. McAlvany.com. And if you're interested in something that we've done as kind of a banking alternative, just very inexpensive to buy and sell, vaulted.com is our company. That's a fintech solution for, very easy and easy out allocations to gold and silver. Silver there is the cheapest you'll find anywhere on the planet. We're partnered with HSBC in London. You're owning 1,000-ounce bars at the lowest cost basis you can find anywhere on the planet. So pretty intriguing. Vaulted or McAlvany.com. Those are great resources. Thanks, Mike. I appreciate being with you.
Thank you, David. Have a wonderful spring.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.